They are on Moodle. Yeah, so the PowerPoints are on Moodle. I write these for this textbook publisher. Just because the ones that they have before I started teaching this class, I didn't think were very good. So I started writing my own, and then somebody said, hey, maybe they'll buy them from you. And in fact, that was a decent idea. So, okay. But they've just kind of rewritten the book, so this has all been reworked in the last couple of years. I mean, obviously, they need to be reworked every year anyways because the numbers change. But they just split this chapter into 2 chapters. So income and expenses, we're going to be working off of the front of the 1040, the front page of the 1040. And this unit chapter is going to start us, we're going to do Schedule C. We're going to look at transportation, travel, M&E, meals and entertainment, I'm going to call M and E, right? Meals and entertainment. Business education, you can read all these things. So this is basically what we're going through. It's essentially what you'll find on your Schedule C. Okay. Defining a trade or business. It's not specifically identified in the Internal Revenue Code, but it's anything you're engaged in for a profit. What I get all the time is a client who comes and is like, oh, I took a couple photos. I like to take photographs. I got this really expensive camera equipment. And I went to Vietnam last year and I sold one of my pictures. Right? I took a great picture. I sold it. How much you make on it? I sold it for $500. How much camera equipment do you want to write off? 10 grand. Is he in the photography business to generate a profit? I mean, he could make a case that he is. No, you have to show 3 out of 5 years. So, and I mean, clients and I get into this all the time, especially with, that's a really good example of horses.
You have to show what?
3 out of 5 years profit.
So, if your business consistently underperforms, it's no longer considered business?
No, it's considered a hobby. Because nobody is going to engage, and that's not underperforming, it's not even breaking even. It's losing money year after year. How can you call it that that's your...
And do they mean literally a profit, or does that have to be...
Tax profit. No, literally a profit. 0, better than 0.
So...
A buck.
You net $10, you're good?
Yep. For a deduction to be deductible, it's got to meet all 3 of these criteria. It's got to be ordinary and necessary. That's got a wide interpretive lens, as you can imagine, right? Because what might be ordinary and necessary to take a client out to eat in Missoula, Montana might not look at all like that in Manhattan. It's got to have a legitimate business purpose. And it's got to be reasonable in light of the fees generated. So if you're going to be I'm going to get a $700 commission from selling you a financial product, taking you out to a $2,500, extravaganza in Vegas doesn't make sense, does it? Right? So that's what they're going to look at. How much did you spend on the expense versus what could you have generated in revenue from it? That's a pretty good linchpin. Okay, Schedule C, can you remind me what the name of the Schedule C is again? Is that the name of it? I don't even know. I think it has something to do with trade or business, doesn't it? Well, you can fill out a C, or you can fill out, your software will default to an easy, a C, easy, if it meets a number of qualifications. And the qualifications are like, you don't have any depreciation, you don't have any employees, you don't have office and home, right? So your Schedule C isn't complicated at all. It's like super like money in, money out. That's it. No inventory, right? So then you fill out a CEC. Sorry?
Oh, no cost of goods sold.
No cost of goods sold, none of that.
Yeah. Contractors, self-employed contractors, Schedule C.
Mm-hmm. Absolutely. When do you have to do a Schedule C? If you earn more than what? $400. When do you get 1099 as an independent contractor? That's $600. So there's a weird little discrepancy in there, but at any rate, yeah, absolutely.
But if you're an independent contractor, are you by default then self-employed first?
Yeah. And so I struggle with that with clients too. Like, You know, I've got, like I do one of my buddies, he's a professor, and like 3 years ago, they asked him in Rhode Island at Brown to come out and do a speech on sustainable agriculture. So he flies out to Brown and, Providence, does the speech, and he's like, and I had to do a whole Schedule C for him. He's like, well, I'm not really self-employed. I've only done this once. I'm probably not going to do it again. But I'm like, if we do this, then I can, we got to do something with your 1099 because he had a 1099 for $3,000. We've got to have the 1099 reflected somewhere. Don't we want to write off your flight and your food and your hotel and your car rental and all the stuff while you were there? Well, sure. So we had to set him up on Schedule C.
If people who was working for pay for those flights and expenses and maybe aren't things that go on, still become 1099 as income payment.
No. But then obviously you can't write off the cost of it, so you can pay for it. Okay, gambling. Do we have to pay tax on our gambling winnings? Yes. What do we get to write off against it?
Losses of $3,000.
Gambling losses. Well, no, the $3,000 isn't the number here. If I make, hit 28,000 at Grey Wolf, can I only write off 3,000 in losses? No, I can write off up to 28,000 in losses in that year. Okay, so I can net it down to zero. I can't take it into a net loss on my tax return. And this is where, okay, so how do you get your gambling? Like say I've got a friend from Thailand that loves to gamble, and she always needs to win. She's just very vested. So what does she get at the end of the year from the places that she gambles? She did get comps, but a 1099-G for gambling, right? And I think one is generated if you win more than $1,300 in a day. They come and get your picture, your driver's license, and social security number, and all that good stuff, right? So she doesn't get a schedule. She doesn't have to do a Schedule C because she's not a professional gambler. But it's going to go on, I don't know what line it is offhand, it's just called other income on your tax return. And so she's got it, it's going to go there. Where does she write off her losses? On her Schedule A. What if she doesn't have a Schedule A? Then she doesn't get the losses. She's got to do the winnings, but she doesn't get the losses. Are you with me? So the 28,000 is a bad example because that would throw her over me. Say she's single, say she made $2,800 in gambling winnings and she doesn't own a home. What's the problem? She's not going to itemize. She's going to have standard deduction, so she doesn't get her $2,800 in losses, does she? See? Yeah, the 28,000 wasn't a good example because, of course, that would throw her over the standard deduction. But if she was under, then...
So if you're a professional gambler, you're self-employed?
Yep.
But the gambling losses you incur wouldn't be deductible by any
Oh, no, on the Schedule C they would. On the C they would. I've never done somebody who's a professional gambler, but yeah, their expenses of doing business would all go on Schedule C.
Those gambling losses.
Yeah. The expense of doing business.
So would it make sense if you're a gambler because of a really bad streak to declare yourself as a professional gambler for 1 year?
I've never done it, but I'm pretty sure there's a bunch of caveats and things that you have to check off to indicate that you are. Self-employment tax. So if you have net earnings of $400 or more, you have to pay SE tax. That's what I will call it from now on, SE tax. And that percentage is? Yeah, it's at 15.3, but then I think we went through the process of realizing that then we've got to multiply it by that funky number, right? Too many martinis. Focus. Focus. Please focus. No? I mean, yeah, I have no idea what's going through its little computer mind when it does that. Okay, SE tax. It seems to be when I write that it throws it off. Okay, so it's 0.153, right? But then if you recall, I put this up on the board. To calculate it for purposes of your manual recap, then you have to multiply by 0.9265. Okay, that shows up on your tax return. Oh, they brought this up today. Online, tax return, I can tell you. Okay, so your SE tax shows up on line 57. But then you also get a deduction for AGI of half of it on line 27 on the front. So this goes on line 57 as the tax, right? This is on the back of your 1040. But then half of it goes on line, what did I just say, 37? 27, as a deduction for AGI. God bless.
So your net is that you're still paying basically 7.65%.
No, you're paying 15.3 times 0.9265, reduced by half of that number. Now, this number jumps significantly. We're using 118.5 because that's the textbook we've got. But for this year, and I don't think I've ever seen it jump this big, that the cap on OASBI this year went up to 127.2. So it made a big jump. Usually it goes up like $2,000 or $3,000 increments. It made a pretty big jump. Okay, and then we know that there's that 0.9% that we've got to calculate on if you make more than what?
200
Yeah. 2 if you're single, 250 if you're married. Then you've got that extra 0.9 on the amount over that, tack on. Okay, inventory, cost of goods sold. On Schedule C is a 2-page form. On the second page is your cost of goods sold section. And it reads just like our model. Who remembers what the model looks like for cost of goods sold? Beginning balance inventory.
And then amount sold or something less what you're left with at the end equals cost of goods sold.
Yeah. Beginning balance plus purchases gives you something called cost of goods available, right? What do I have available to sell? And then in our classic accounting equation, we obviously subtract what's still sitting there at the end of the year is our ending balance, and the difference is what we sold. On our cost of goods sold model on our tax return, there's also an item, a reduction item of items withdrawn for personal use. Okay. And I think you learned in accounting too, right, that there's different ways to cost inventory, FIFO, LIFO, and weighted average. And what do you imagine most people use? And you've got to use the same thing for tax as you do for your financial statements, right? What do you imagine most people use for their method? What's going to give them the best tax result? In other words, the biggest write-off now. Yes, and we're assuming most inventory is subjected to inflationary pressures. Good question, though. Good clarification, because if it was a deflationary product, it'd be exactly opposite. Huh? Exactly flip that. Yeah. Last in, first out, because the most recent products that I purchased are the most expensive, and those are considered to be the first out, so they flow through my cost of goods sold. So that elevates, it defers taxes to the future, doesn't it? Okay, Now we're just starting kind of going through, actually, we should probably pull a Schedule C. Can somebody find one for me? I think they're in the back of your book in that, whatever the appendix was we were looking at. Okay, so here's my Schedule C. Did you guys find one?
Oh, I just saw it.
Okay, what page?
E11.
E11.
It's gonna be filled out.
Okay, so can you see the text in the background? All right, so up in the top, there's nothing too terribly interesting here other than line item B says enter code from instructions. You're going to have on your software, it's going to link you to a list of different kinds of, they're called SIC, standard industry codes or something like that, that says, am I in textiles or the service establishment? Am I a veterinarian or a computer engineer, right? So that's the only thing that's interesting there. F, accounting method, am I cash or accrual? G, you want to have materially participate, you want to check yes. If you started or acquired the business in the current year, you got to check yes. And then I and J, did you make any payments in 2016 that requires you to pay to file 1099s? In other words, in your business, did you hire an independent contractor for more than $600? If you did, so if I brought a subcontractor onto my tax business and paid a student a couple $1,000 to help me, yeah. Did you have to file a 1099? Yes. Did you file them? If you say, yes, I needed to, and no, I didn't expect, you're going to get what do they call it? Like a letter audit, and you're not going to go to the IRS office, but you're going to get this big form you got to fill out. Okay, so you say yes, and file your 1099s. Okay, income, this is just the top of a P&L, right? Gross receipts minus returns and allowances minus costs gives you gross profit. I don't think I've ever seen, I don't even know what line 6 is. So 5 and 7, essentially the same. And then really here's a P&L. And it's all the common categories, and if it doesn't fit one of the common categories, you're gonna put it down here in line 27A, which is other. And so really what we're doing in this chapter and the next chapter is digging into some of these categories that are a little bit, a little bit more to talk about than others. I mean, legal and professional services, there's really nothing to talk about. This is your accountant, this is your structural engineer if you're a builder, right? You can't deduct personal legal expenses, but you can deduct corporate legal expenses. So if you hire me to help you with your bylaws and your entity planning, should I be an LLC or an S Corp, and I'm an attorney and I do that for you, great, but you're going through a divorce, $5,000 into it or whatever, personal legal expense is not deductible, right? So that's all I have to say about that. So lots of these, there's really nothing to say about them. If you have questions about where things go, where do you go to find the answer? You're going to go to the instructions. And I mean, I will tell you, this particular form, right here, the instructions for Schedule C, very, very, very useful. Very useful. So use it. Okay, so that was a long way of saying I'm just going to talk about the things that really have some level of complexity to them. So transportation is different from travel. Travel is when you're away from your tax home for more than 24 hours or long enough to need rest, I think is the language. Whereas transportation, you don't need to be away from your tax home long enough to need rest, or 24 hours, whichever is short. So what would be an example of something that's deductible? So commuting is never deductible, right? The cost of getting to and from work is never deductible.
Go to a trade show.
Yeah, okay, so you work in LA,
and, you know, you, what, I don't know, you live in the valley, you work in Bel Air, you go to a trade show in Laguna, right? That's the cost of getting from Bel Air to Laguna deductible. I take the toll road and I pay a toll deductible. I have to park for $50 to go to the damn trade show deductible, right? That's all work transportation.
Meals and accommodations.
Absolutely, everything. That doesn't fit into the transportation category, but it's all deductible. Now, and that's just, it's never deductible if you're traveling between, or no, it's never deductible except if, and we just gave that example. Traveling between home and work, and outside of my normal metro area, the example I gave of Garza Laguna, where a taxpayer is regular place of business. Or I'm traveling between home and a temporary work site when I have a regular place of business. So I'm a construction engineer for Jackson. You know, I live in the Rattlesnake. They just built a place out on 93, but I'm building the new hospital in Thompson Falls. Right? So that's my temporary place of business, isn't it? That's where the work site is. So when I go between the Rattlesnake and Thompson Falls, that's deductible because my regular place of business is where? Jackson Contracting here in Missoula. So, and then the third one, this is a really good caveat. If your only office is in your home, every time you walk out the front door, it's deductible because you're leaving your place of business. So when clients ask me, should I track my mileage, I've got to dial in and see what does their average work week look like. And these are the three questions I'm trying to get at.
So like, if you have your own cleaning business
Mhm.
that's operating out of your house,
That's all
you're
deductible on your
like
schedule C.
capital sold, track those months.
All deductible because your office is in your home, so when you walk out your front door, it's deductible. You can always deduct the additional cost of hauling your tools or your instruments. I've got a couple musicians, a couple bands comprised of musicians, and I do the individual musicians' tax returns, and they hire, depending upon whatever they're doing, yeah, well, or they need vans or RVs or, you know, trailers that are secure to haul their stuff. That all the cost of that's always deductible.
Or my personal favorite, when you have subcontractors doing work on your house and they pull up if they're going to be there for a while and they've got all their tools, right? But they're going to park next to your house for a couple of weeks while they do a remodel. And then you realize, oh, the tile guy's sleeping in the on the back of the flatbed that's parked in my driveway. It's like, I don't know if that's okay. I guess everyone's got to be somewhere. Where am I? Okay. So the tricky thing, or not tricky thing, but what you have to do to maximize benefits to your client is make an assessment if they're driving their car, if they should take standard mileage deduction. That number changes every year based upon what gas and general inflationary pressures on cost of running an auto. Last year it was 54 cents. Plus, you still get all these items, parking costs, tolls, and license plates on your car, and any auto loan interest if you're self-employed. I'm going to go back to this, so let me just paint the two categories. So the question is, you come to me, you're a new client, you're like, I am a weaver, and I go to these trade shows all over, and I bought a special van to haul all my weavings to the trade shows. Should I take mileage, or the next page is actual. So, and I have to do a calculation if it's going to make more sense for this client to go with a standard mileage deduction or actual costs. Okay? So the way standard works, you get 54 cents, and then she says, well, I spend a lot of time in Seattle, so I've got to park. She gets to, in addition to the 54 cents, get all of her parking. Any toll she pays is in addition to the 54 cents. And the cost of her license plates on her van is deductible in addition to the 54 cents.
Traffic violation fees.
No, never anything you have to pay because you broke the law. And she's self-employed, so she gets, if she borrowed money to buy the van, she gets to deduct the portion of interest that's allocable to the miles she drove for business. Okay? Do I get any of this stuff as an employee? No. You do. If I drove on behalf of the university, right? I'm trying to think of an example where a professor would do that. Say that I'm a respiratory technician prof, and I go to Billings and Butte, Great Falls, and supervise clinics there, and I drive my own car. Don't I get that as an employee? But I don't fill out a Schedule C, so where's it gonna go? Sorry? It is. It's gonna be a job, what's it called? Employee business expense on a Schedule A. So what this is all saying here, this all would apply to you too as a respiratory tech professor, except for I'm not self-employed, so I wouldn't get the auto loan interest. But I get all those other things. When a client comes to me and I'm trying to make that original assessment of standard versus actual, I've got to make sure that he or she complies with all these. Most of this is over our scope. I'm not going to go into it right now. But really, this is the big one. Hey, is this your car? Well, no, my dad owns it. Or it's my grandma's. Well, no, then we can't do it. Okay. So either standard, which is this slide, or actual, which is just what it says. You save every stinking receipt. I got my tires rotated. I got my oil changed. I bought a tank of gas. Okay. But once you're committed to actual, you can't shift to standard. Actual will almost always actually look better up front because you get depreciation. Okay? But you have to ask questions like, how many miles are you going to put on your van a year, Stacy? And how often do you foresee, flipping your van, not flipping, but turning over your van and getting a new one, okay, to make that assessment. If I start her out at standard, she can switch. So you can make one switch to actual, but then she can't use accelerated depreciation. She's got to use straight line. This may be getting a little over our scope. Just take it at face value for this one.
You switch the depreciation tax year.
No,
So
this is a one-time choice. So if I start her out as actual, that's it forever,
what the business.
like the car. If I start her out standard, I can change her once to actual down the road. But then she doesn't get the big depreciation, the accelerated depreciation write-offs. And always, 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 you've got to multiply anything by the percentage of usage. So let's do an example. Let's say that I've got a car. Why don't you do this for me? I got a client comes in, she says I'm going to drive about 10,000 miles a year, are her projections, and she thinks she's going to hold on to it. This is going to be too much to do because then we have to use the depreciation tables. Okay, let's just do something else. Let's say that she says, this year I drove 10,000 miles for business. The total miles I put on my car was 14,898 in total. And my actual expenses were $2,000 in gas, $1,250 in repairs and maintenance. And I look up and get the depreciation out of the tables. Let's say it's a $25,000 car, 20%. $3,320 of depreciation. And what else do I have? Is that everything you have for your car? Plus my plates, but you get those. Okay. So do an assessment for me and tell me just for a 1-year snapshot, should she take actual or standard? And pretend it's going to look like this every year, which it's not because your depreciation changes. I just pretend it does.
Okay, but, right, you want to do the actual versus standard comparison. I've got to figure out too, because I can't do that in my head.
That's $54 a mile, right?
Yeah, so that's standard,
So that's $100.
but which is more lucrative to her?
Check those deductions all the way there. That exceeds $100.
Yeah, but does she get all of them? Is that what the number ends up being? Okay.
And that is 44.77.
Okay, so it was close. So actual 4402. Standard 5400. See what you got to do? She doesn't get all of her actual. She only gets the percentage that's allocable to business travel. In both cases, she's going to get all of her license plates and all of her parking and tolls. So those never go into the allocation pool. You get all of those, 100%. So if this was going to be the scenario year after year, you'd say standard, right? Okay, everyone catch up? Okay, so that's what this last phrase here means then. Business use percentage is what you have to apply to it. On the bottom where we were just talking about the example of being the respiratory tech professor, and I said, do I get those miles if I drive for work? I do. They go on my Schedule A. And so I'm introducing a new form. Form 2106 is where you compile all of your employee business expenses. So I'm the respiratory tech professor. I pay to travel around the state to do clinicals. I buy my, I just renew my license every year, right, for $500. I probably got to do some continuing education. Cost me $300-400 a year. Those are all employee business expenses, things that I incur to keep my job that comes out of my own pocket. I mean, I have a ton of those too. I belong to the AICPA, I belong to the Montana Society of CPAs, I belong to the Institute of Management Accountants. You've got to do continuing education for all those. I've got to pay licensure fees on all those. Now, let me pose this question. Should I take those costs? And I mean, lots of times they come to a couple grand a year. Am I going to take those costs to my A or to my C against my tax business, and why? And I do file a Schedule A. It's going to come right, it's going to come off the top on either of them. If I itemize all 2,000 of that's going to go to my Schedule A, why, or doesn't it matter? It doesn't. You guys know the answer to this. Do I want it on my C or my A? Why?
It's how you do the business. It's because it can be an additional deduction if you're only taking standard.
On my C, you guys, what taxes do I say in any deduction that I push to my C? Everyone can tax. Oh, that thank you. You're close. And I say federal income tax and state income tax, but if I push and expense my C, I'm getting out underneath what? Yes, SE tax. Right there, you guys, $2,000 on my Schedule A since it saves me $2,000 times my federal and state income tax rates. It just saves me another $300 if I push it to my C, right? $2,000 times 0.153 times 0.9265. That saves me $300 in self-employment tax. Now, are you with me? My primary employment happens to be close to what my self-employment is. If my self-employment was photography, I wouldn't have a choice where I pushed it, right? I would have to take it on my 80. But I can make the choice because they're make an argument, I may have all those expenses to be either. So in my case, that doesn't go on my 2106. It goes on my C. And that's where you have value. That's where the H&R blocks and the turbo taxes are like, people just, push shit in and hit return. They don't know. This is where you add value as a tax preparer. And I almost guarantee if you get into tax prep and you get a new client, they're like, or you're talking to somebody, they're like, why would I pay you $250 when I can do it for $69 at H&R Block or free on TurboTax? Bring me 2 years of your old tax returns. And I'll get you some refunds, making amendments. And then you have a client for life. And you can do it with something as simple as that.
Okay, travel expenses. Travel is different from transportation. You need to be away from your tax zone. Again, ordinary, necessary, substantiated, not lavish. Lavish looks very different for different people, doesn't it? So a lot of this stuff gets caught up in court. Meals in any situation are only 50% deductible. So no matter what you spend on your meals, it's times 25. Same with entertainment.
Don't include meals and entertainment, say winners and points.
Your entertainment has got to occur directly before or directly after some sort of business event. So, classic like going to Vegas or whatever. We have a business meeting and then we go to the, J-Lo show for $300 a piece tickets. Yeah, but that was right after the business meeting. And we talked about business while we were watching her dance.
And that's
Yeah. Sure you were. Yeah, 50%. Okay, so travel status requires being away from home overnight, long enough to need relief from work. Blah, blah, blah. Okay, this is interesting on the second bullet here. So your tax home might not be where you live. Your tax home is your primary place of business. So I've got a client that runs a crab fishing boat out of on the that's the strait up there, the Barrow Strait, right? Is that northern Alaska? Anyways, crab fishing boat. That's his primary place of business. That's where his employees are. That's where his boat is. That's where his inventory is. That's where his packaging plan is. So. He is actually on travel status whenever he leaves Barrow, Alaska, because that's his tax home. That's his primary place of business. Okay? When I did 6 months on exchange in Australia, all the costs of living over there for 6 months were deductible because I was away from my tax home on work. Right? I was 99% sure I was going to get audited that year, and I didn't. I thought that was pretty interesting. Expenses of temporary assignments are deductible if it's not practical to return home each night. Right? I was living in Wagga Wagga, Australia. It wasn't practical to return home every night. I got to pay off all my rent, all my utilities, all my everything would normally be a personal expense I got to write off. But if it had been over a year, then they would have reclassed my tax home, but it was only for 6 months.
Now, this is the last thing that you need to kind of focus on. I know you guys are kind of tired and I've seen a lot of people yawning. But this is important. So when clients travel, the first thing you need to figure out, the first caveat is, did you travel internationally or did you travel within the country? Because there's very different rules. If you traveled in the country, the next question is, was it primarily for business or primarily for pleasure? Oftentimes people would mix both, right? I went to see my sister in Austin, and when I was there, I went to UT for a day and had a conference with some other business professors on curriculum development. Okay, that was primarily for pleasure, where I had 1 day of business. Or I went to a conference in San Antonio for 4 days, and then at the back end of it, I drove over to Austin for a couple days with my sister, right? So that's how you have to define it, and it's actually based on days. How many days were you engaged in each activity?
In the second example, primarily business trip, I was presenting at a conference in San Antonio. All my plane tickets deductible and the allocable portion of my hotel and my meals and rental car and all that stuff. So 4 6. Right, I was gone 6 days, 4 in conference, 2 with my sister. If it's primarily a business trip outside of the United States, I'm going to Paris, I'm presenting at a conference there, and then I'm going to go down to, the Loire Valley for a couple days afterwards. Then I've got to allocate my plane ticket, even if it was primarily to go to the conference in Paris. And then, of course, everything else is allocable. If it's primarily a pleasure trip outside of the United States, you're not going to get any of your plane tickets. Okay, so I'm going to go to the Loire Valley, and at the end, I'm going to pop in and see a research colleague in Paris. No go. Travel costs to and from are not deductible. And always everything's split.
So let's just try a couple of these and then we'll call it a day. Okay, so Gretchen is a sustainability director. She travels from Idaho to New Mexico for business. And she pays $380 for airfare. She spends $330 on lodging, $150 on meals, and while she's there, she goes on a personal sightseeing tour of the Turquoise Trail and spends $400 on car rental and lodging, $85 on meals. So what of all this is she going to, what am I going to tell her she can write off? She gets $380. Did she get all of her lodging? So she gets $330 up here, and she doesn't get any of it down here on the Turquoise Trail, right? What about the $150 on meals? Half of that, right? $75 for that. So $455, $880, $785, I guess. Yeah. So $785. So people will come to you and they will throw everything at you and say, here, take all of this. You've got to ask the questions. Again, if you put that into TurboTax, guess what? It's going to spit it all back out at you, and the deduction is going to be overinflated by $700. So you've got to ask the question, what portion of it was personal, what portion of it was business? Okay, per diem. What does per diem mean? Yeah, every day. Here's the scoop. With tons and tons of clients, there is no way in God's name they're going to hold on to all their receipts, particularly if they travel a lot. What are they going to do? They're going to take a daily rate. The government gives us 3 options, right? And you only have, you can only do one of them if you are self-employed. Now, you can take the regular federal rate, you can take the high-low rate. I'm just going to introduce the 3 methods. Or you can take M&IE. And if you're self-employed, you have to take this one, M&IE. Yeah, these are for people that choose to go per diem. So I'm saying, like, lots of clients, they just can't hold on to their receipts. At the end of the year, I'm like, where are your receipts? They're like, I've got 3. I'm like, you were in Europe for 2.5 months with your band, and you got 3 receipts. Like, dude, you were missing. So then we go to per diem. Okay, and all they have to do there is just give me copies of, like, their travel itinerary, so I can figure out how many days they were in Budapest and how many days they were in Vienna. And then you go to these charts, and it's all over the world, and you pull out daily substantiation, or daily per diem rates. Okay, they're self-employed, which the band members are, they've still got to hold on to their lodging receipts. Because if you're self-employed, this is the method you have to use. You get the actual amount of your lodging and then a per diem for M&IE. And in the United States, for last year, it was $68 and $57. Areas that are called high cost or low cost, and that's all on a chart that the IRS provides us with in a publication. But if like my clients are in Europe with the band, they've got them printed out all over the world.
So you have to go look at it. And that takes time and money, and that's reflected on your bill. Okay?
So the other two methods are only if you're an employee. Regular federal rate method or high-low method. The regular federal rate method everybody gets the same rate no matter where you are. If you're on the high-low method, the regular federal rate method is broke up into little tiny micro pieces of travel. And so people travel like a ton. That's very time intensive to look up every single market. High-low method's way easier. It says everything's low except for these 10 markets. And it's just what you imagine, like San Francisco and Manhattan and LA and Seattle and high price places. So per diem eliminates necessity of keeping copious records. Your rates are split into meals and lodging, and the meal rate they give you, you still got to multiply by 50%. Okay. Let's see, on Thursday, you should read chapter 3, finish your 2 cases, and start, if you can, on the manual recaps for them. Okay, can you begin? Elizabeth? Grab a chair here.